In this video, we will look more closely at the income statement and the statement of cash flows. The income statement shows the firm's performance over a period of time. Typically, that would be over a month, a quarter, or a year. Here I want to look at a simplified income statement, and I want you to be familiar with the items listed here. The top line is revenues and is clearly a very important number to keep an eye on. The cost of goods sold is an important expense item and one to keep an eye on to make sure it is not growing more rapidly than sales. The cost of goods sold is a direct cost that will vary with the volume of sales. If we sell more, typically the cost of goods sold will be higher. If we sell less, the cost of goods sold should go down as well. Another expense item is the overhead for a company, here shown as selling, general, and administrative costs, or SG&A. These would be indirect costs associated with running the company. At this point, if we take out the cost of goods sold and the SG&A from the revenues, we are left with something called EBITDA, earnings before interest, taxes, depreciation, and amortization. This is an important line item, and it is one measure of a firm's operating cash flow that is frequently talked about and looked at in valuation. Next, we would take out depreciation and amortization to get to EBIT, earnings before interest and taxes. This is a measure of a firm's operating earnings. It takes depreciation into account, but it's not affected by a firm's capital structure choice or by tax policies. So this is a good number to use to compare different firms' operating performance. After depreciation, we take out interest paid, which leaves the taxable income. Out of that, taxes are paid and we are left with the bottom line, net income. And again, this is a very important number that is frequently talked about in the financial press. This last part here shows that any dividends paid come out of the net income for a firm, and the difference is the addition to retained earnings. Please note that this could be a negative number if either the net income is negative or if the dividends exceed the net income, then the addition to retained earnings will be actually a subtraction. Another quick note, net income is not the same as the cash flow for a firm. In finance, we are much more concerned with cash flow, and we're going to be looking much more closely at that in the next video. A few important notes on the income statement. We care a lot about top-line growth, the growth in sales. Healthy firms generally have increasing sales levels, and the rate of growth is very important. Keeping expenses in check is important as well. We can look at the margins, or the percentage difference between the revenues and particular expenses. We look more at margins when we take up financial statement analysis. Operating income is a critical number to watch. EBITDA is operating cash flow and EBIT is operating income, and we would like both to be strong and getting stronger. Shrinking operating income is not desirable, and we need to make sure we have enough operating income to service any debt we have and to pay the government their share. Then there is the bottom line, and we would always like net income to be growing. With all of these items, however, investors really care about what is sustainable. That is, what will be there next year and the year after. If there is a one-time spike in revenues that won't be around in the future, the market will not react favorably to that. So managers and analysts will keep their eyes on things like seasonality, where there might be wide fluctuations from quarter to quarter. No retailer would get very excited that their fourth quarter sales were well above third quarter sales, because that is the nature of their business. More important would be what is called year-over-year sales growth, comparing this year's fourth quarter to last year's fourth quarter. If there's other income that the firm receives, we may not pay that much attention to it, especially if it is a one-time occurrence, like extraordinary items. These are things, whether good or bad, that are not expected to recur in the future. Many times analysts in the market will ignore these items and look at what the results would have been if the extraordinary items hadn't occurred. The last financial statement we will look at is the statement of cash flows. Its purpose is to show what caused the change in a company's cash over the accounting period. There are three broad categories of activities that can affect a firm's cash position. The first is a firm's operating activities. This is cash flow that comes from the company's normal activities of producing and selling goods and services. Ideally, we would like this cash flow to be a positive amount, but for young firms or rapidly growing firms, this may not be the case. To get the cash from operating activities, we first start with net income and add back non-cash expenses such as depreciation. The other big adjustment that is necessary is to examine the changes in working capital accounts, that is, in the current assets and the current liabilities. If current assets are increasing, then that will use some of the firm's cash. Think of inventory as a typical current asset. If you are increasing inventory, you are using up cash to build up a pile of things that you're going to sell in the future. Then those assets will turn back into cash once the sales are made. So if inventory is decreasing, that will generate a source of cash. Another current asset is accounts receivable. Just like inventory, if it is increasing, it will be using some of the firm's cash. And on the other hand, if accounts receivable is decreasing, then it's providing cash to the firm. Then there are the current liabilities. They're the opposite of the current assets. So if they are increasing, they are a source of cash. Think of note payable as a typical current liability. If your short-term loans are increasing, that is because you borrowed more money and you now have more cash at hand. If those loans are decreasing, on the other hand, it's because you have used up cash to pay those loans down. The second category of items that affect a firm's cash position is its investing activities. This category reflects acquisition of fixed assets or sales of fixed assets. If a firm is buying a lot of long-term assets, they will be using a lot of cash and would have a negative cash flow from investing activities. If a firm has positive cash flow from investing activities, it means that they are selling off assets and shrinking. Whether that is good or not depends on the situation the company is in. For a normal growing company, this line item would be a net use of cash. It would be a negative amount. The third category of items that affect a firm's cash position is its financing activities. This reflects any new debt or new stock a firm issues, or if the firm has paid off debt or repurchased stock. In addition, any dividends paid would be reflected here. An important consideration is whether a firm is generating sufficient cash from operating activities to maintain the firm and support growth of the firm. In the next slide, let's look at a few examples of where cash flow is coming from and how that is important. So with this first firm, a young, rapidly growing firm, what we might see is negative operating cash flow, but there are growing revenues. So there's some signs that good things are happening and we have things to look forward to in the future. There would typically be negative cash flow from investing activities as the firm is buying up assets and expanding its asset base. And then we'd expect to see positive cash flow from financing activities, which would come from heavy borrowing or heavy issuance of stock. A mature firm, on the other hand, would typically have positive operating cash flow. They might have slightly negative cash flow from investing activities as they are replacing worn out assets over time. And then we might see negative cash flow from financing activities as these firms pay down their debt or are issuing large dividends. Finally, for a troubled firm, what one might look at and see is negative operating cash flow. And this is where a firm maybe would have shrinking revenues or rapidly increasing expenses, so not really good things that bode well for the future. It might have positive cash flow from investing activities because the firm is selling off assets for the cash that they desperately need. And then no cash flow from financing activities because the firm can't borrow anymore. There's no lenders that are willing to give them more money because they're too big of a risk. And likewise, no investors are willing to buy equity in the firm. So it's important to look at each of these three categories and to see what kind of story they're telling you about the health of the firm. So we'll pick up with looking at free cash flow and how to calculate that in the next video.
Dollar, that's what I need. Hey, hey. Well, I need the dollar, something